What's up, everyone? All right, so today we're going to get into lesson 4, which is technical analysis. Now, this is kind of the meat of the class. As traders, we are so focused on the technicals, and it doesn't matter whether you're trading stocks or cryptocurrency. Technical analysis is what we use to find strong entry points with a minimal amount of risk and a maximum amount of profit potential. So the topics for today, when it comes to technical analysis, we're going to define what it is so you guys understand it. We're going to show you candlestick price charts. These are the same charts that we use when we're trading stocks, and so many of you are already familiar with them, but we'll just do a brief review of candlestick charts. We're going to talk about performing technical analysis, and then we're going to get into talking about common price patterns. So these are the candlestick patterns that we utilize to find strong entry points. All right, so Arsh is with me here again today, and I'm going to let him talk a little bit about technical analysis.
Yeah, so let's get right into it. Technical analysis is a very popular way of evaluating price charts, and it's a methodology that helps you analyze historical data to help you predict what prices may do in the future. So we're eventually evaluating all of the trades that have taken in the past, and we may use something like a candlestick chart to do that. Our goal is to really use that information to our advantage by helping us locate good entries and exits on our trades. There's probably hundreds or thousands of different technical analysis trading strategies, but ultimately our goal is the same, and that's to find a trading edge that's going to help us put the probabilities in our favor. So as you gain experience as a technical analyst, you'll likely be able to spot these major trading opportunities that become visibly evident on the chart. Technical analysis is also really a universal concept that works practically in any market. So it works in stocks, futures, cryptocurrencies, and if you understand technical analysis from stocks or any other kind of trading, that's really great because those skills can also be applied in cryptocurrencies. But even if you don't worry, because we'll teach you how those concepts can be applied in this presentation.
Yeah, and one of the things is that I noticed for myself when I was learning how to trade, I kind of had this hunt for the holy grail. Like, even when you look at this slide here, you can see these like oscillating indicators, and they go from green down and up, and you think, geez, maybe if I find the perfect combination of technical indicators, they'll do the hard work. They'll tell me when to buy and when to sell. And the reality is it doesn't exist. I searched for it for a long time, but what you can do is you can use them to help you put the odds in your favor, to help you get that edge. They're not going to do all the work for you, but they can help you. Now, those are technical indicators, and we use a couple of technical indicators, which we'll talk about more in this class, and primarily we rely on candlestick chart patterns rather than the indicators themselves. And that's because a technical indicator is always going to lag behind price action. A technical indicator takes its information from the price, but it requires the price to go up and down before that indicator is going to give you a signal. So the price has to happen first. Now, if we just look straight at a candlestick chart, we're looking right at the price, and so we don't have any lag or any delay if we can immediately make an interpretation. So that's the goal. But technical analysis includes all these technical indicators and reading candlestick charts. So this is the breakdown of a candlestick. Now, every candlestick that you see represents a period of time. A green candlestick right here has 4 pieces of information it's telling us. It's telling us the open price, which is the bottom of the candle. It's telling us the close, which is the top of the candle right here. So this body right here, this is obviously the stock moved up during this period of time. Down here is the lower candle wick, or the lower shadow. This is the low of that period. So let's say this candlestick represents 15 minutes of time. Within that 15-minute period, at the beginning, the price was right here. At the end, the price was right here. And sometime during that 15-minute period, it dropped down to here, it spiked up to here, but then it closed right here. So those are the 4 pieces of information: the open, the close, the high, and the low. Now with a red candle, we see the same thing. We see the open price and then the close price. The only difference is that they're inverted because the stock went down. So that's how we need the candles to be colored to know whether the price was going up or down. I mean, visually you can sometimes see it, but if a stock is kind of sideways without the color, you wouldn't know whether the top was the open or the close. So what's really interesting is that when we take these 4 pieces of information, they can actually communicate a lot to us. So imagine, for example, if this candlestick had a high shadow that went way up here. Let's say it went way off the chart. What that would tell us is that inside that 15-minute window, the stock squeezed up, but it came back down. And on the one hand, you could think, well, that shows strength, but it actually shows weakness because it came back down. So we call those topping tail candles because they've got this long upper wick. Inverted is a bottoming tail. A stock squeezed down, but then it got bought back up, and that's actually showing some strength. So just the actual shape of the candlestick can help us make some interpretation about the market sentiment around this particular stock. And I should have prefaced that by saying that these candlestick patterns are most significant when they appear in the context of a strong move to the upside or a strong move to the downside. We don't really look at candlestick patterns during sideways consolidation because the fact that the stock is already sideways tells us, the market is a little bit indifferent. All right, so now let's look at a couple of candlestick charts. I'll let Arsh walk you through these.
Yeah, so here we have the Bitcoin daily chart on the left, and we have the 4-hour chart on the right. The daily chart really helps you get an understanding of the bigger picture of the price movement. Right. From current data, we can see that Bitcoin's been pretty weak on the daily chart lately, so that should kind of give you a hint to be extremely cautious when taking any kind of long positions, since it's kind of in a sustained downtrend at this time. However, you can incorporate another time frame, such as the 4-hour chart, to get a better understanding of what's happening in the shorter term picture. So when we look at the 4-hour chart here, it shows us that the selling's kind of ended, and we're now steadily grinding higher. So that's how you're going to use the time frames to your advantage to kind of get an understanding of what's really going on.
And you can see, this is a 4-hour chart, so that means each candlestick represents 4 hours of time. And you can use any time period. The most respected time period for most traders, for day traders, would be a 1-minute chart and a 5-minute chart. Now, a lot of traders who do sort of slightly longer hold times will use 15-minute charts and 60-minute charts. And swing traders usually focus primarily on daily charts, or maybe something like a 4-hour chart just to get zoomed in a little bit closer. But you can see here, as this bottomed out at the bottom, it went from 6,000 all the way back up to 9,000. That's a pretty legitimate bounce. And on the daily chart, you may have said, okay, here's a little bottoming tail, right? So the stock dropped down, but then it squeezed back up, so that shows strength. And maybe you would have seen that as an indicator to buy maybe around 8,000. But of course, if you got in there, you're already getting in 2,000 points off the low of the drop. So that's the advantage of using a shorter time period. You can kind of get that early indicator that the tide is starting to shift. And here you can see that peaking volume at the bottom, right here, the sell-off, the bounce, then a first pullback gets bought up. So a possible entry maybe around 77.50. It's not a lot earlier than waiting for a daily trigger, but it's a little bit earlier. It would have given you a little bit of a jump right there. So let's look at another chart here. We're going in, zooming in a little closer. This is the 1-hour chart and the 15-minute chart. Again, as a day trader, there are times where I've gone all the way down, and it's going to sound crazy, to a 1-second chart. So each candle is actually 1 second of time. And obviously when you do that, there's a million candles in the day, but if you want to get very, very precise entries for quick trades, you can go all the way down to a 1-second chart. It's not very common. Typically, 15-minute, 5-minute, 1-minute would be more typical, but yeah.
Yeah, especially with cryptocurrencies, you kind of want to focus on at least the 5 or the 15, because when you really get into those lower time frames with these things are very trendy, but they, at the same time, they don't break out within a matter of seconds or minutes. Sometimes it takes really an hour or a couple of hours for that move to get going. So that's why I prefer to use the 15 and the 1 hour for the shorter time frame
Yep.
trading, because not only do you get an understanding of the trend, but you can still nail those precise entries using these shorter time frames.
Yeah, and something that we'll talk about in a moment, if you kind of look at this, you can sort of visualize this almost invisible line right up here. If it connects this dot and then comes up to here, this is what we would call a trend line. And so if you did that technical analysis where you drew that line on here, then right in this area, you might be starting to think, well, geez, it's hitting this trend line. Maybe I should be a little careful. And that would have gotten you out of that trade before this drop, right? So, that's something that we'll talk about a little bit more. That gets into the next level of technical analysis. So let me let you, Arsh, walk us through this slide.
Yeah, so now that you guys have a better understanding of what candlestick charts are, we could really get into the technical analysis tools that you can use to begin performing your own technical analysis. So there's many ways to perform technical analysis using a pretty enormous library of tools and indicators that are currently out there. But personally, I like to keep it very simple, and I've found these tools to be incredibly helpful in performing technical analysis. So these include trend lines, support and resistance levels, volume, and moving averages.
Four big ones.
Learning how to incorporate all of these tools into your arsenal can really help you develop an edge over the market. And as mentioned, there's plenty of other tools and indicators you can use, but using too many can really become contradictory, and it might give you contradictory information. So you really want to limit the amount of indicators and tools that you use.
Yeah, it's called analysis paralysis. So you have so many technical indicators, and you could stack dozens and dozens on a chart to the point where they could all be agreeing, but it doesn't necessarily mean it's a buy, or they could all be disagreeing and you just gotta sit there confused. And that's what's more likely to happen.
Right.
Some will say yes, some will say no. You sit there missing opportunities because you're overthinking it. So the four big ones, trend lines, support and resistance levels, volume, and moving averages, those are what we use when we're trading stocks, and they're the same with trading cryptocurrency. So when it comes to the trend line, this is where we actually connect those two dots with a line. And so from any trading software, any charting software, you'll be able to go down to your drawing tools and you'll be able to click on trend lines. And when you do that, you click once for the first dot and you click a second time for the second dot. So one of the ways that I typically use trend lines is I try to find the place where the line connects to as many dots as possible. So I'll maybe click the first dot, and you can use either the top of the candle or you can use the top of the body. There's not really a hard set rule of where to draw the line. My opinion on it is to draw the line so it touches in the most places. Because if you draw a line, let's say for instance, I draw a line that connects this spot right here with this spot right here. I might have been the only person that drew that line because it only touches in two places. Whereas when you draw a line that touches in multiple places, the way this touches here, here, and then it retouches here, and maybe even if we had drawn it a little bit lower, we would have seen it touch right here. That's when you start to say, this is a line that's being respected. I mean, I'm drawing it and I'm seeing over the course of hours and hours that we keep tapping that line. I'm not the only person that drew it. It's a respected trend line. And that's what we want. So we draw them basically where we can already sort of start to visualize them, and then we can adjust them up or down slightly until they connect to as many places as possible. And so what we know is that stocks will often test these types of resistance points. Now, if the stock is below it, it's going to be considered resistance because it's coming up against it. When it finally breaks, oftentimes we'll see a break and then we'll see stocks come back down and retest the breakout point. So they drop back down, and then if there are enough buyers, it will curl back up and it continues on. And that's when you know that that previous resistance is now actually going to become a level of support. When you break through that line, it's now support. So it really can be very helpful to draw these trend lines, whether it's with cryptocurrencies or stocks, to help you identify major levels of possible support or resistance where you could see breakouts or breakdowns. So you can see here, this is a Litecoin chart. I'll let Arsh walk you through the taps of this trend line right here and here.
Yeah, so this will be the 4-hour chart of Litecoin, and we see that we have two major trend lines currently plotted on the chart. Both of these trend lines were connected using the most extended points that we were able to find, which kind of really helps you understand the borders of the price action. When we start coming out of that range, it kind of gives you a sign that the trend is starting to change. Yeah. So what happened here was that the first green box shows that we tapped right into the line and we sharply rejected from there. It tested the line again in the second green box, and again we found resistance there. But we saw that the price eventually stopped going down and it made it back above that trend line with a bunch of sideways action taking place. But what that really means is that the downtrend is likely over for the short term, and we could likely see a breakout over the top of the trend line. And that's exactly what Litecoin did just a few days ago after this picture was taken. So this is a great example of how you can incorporate trend lines to perform this technical analysis and get an understanding of when prices are really ready to move.
Yeah. And on this slide, I would probably have drawn a second trend line maybe from the top of this body, because if I had started a little lower, this would have come up a smidge bit higher and it probably would have cut through here, and you would have seen the trend line would have been right around here. But even if I hadn't drawn that, you can see right here there's a little bit of descending resistance because there's sort of that level. So on this candle here, we broke over that level. So here we were kind of holding maybe support around here, and there was also maybe a second line above it that was this sort of resistance point. So there are times where you'll see stocks kind of pinned between two lines, and it's just a matter of time. Will we break to the upside or will we break to the downside? Here's another example. You can see this Bitcoin chart. This is a 4-hour chart again. Trend line starting at the low point and then connecting right here, right around there, and through here. So I think if this one is connected on these 2 points, we do that because we're like, okay, these are two obvious levels. And as the stock starts dropping down here, that's usually the time that we would draw this trend line, because we're thinking, when is the stock going to find support? Is there anywhere it might find support? Because that's a place I could potentially be a buyer. Right? So if you drew this trend line and you saw, well, there might be a little support down in here, that actually would have been a fantastic entry, because we bounced from $12,000 back up to over $16,000, $17,000, right? So that's a really good bounce.
Right.
And that's how you would have spotted it, is by connecting those two dots. So then again,
and what's interesting is it later, what's interesting is it later found support at that same level, but this time we didn't see that same kind of bounce, right? This time instead, prices kind of consolidated on top of it, as buyers used it as a place for support, but sellers were still kind of in charge, and ultimately we saw that the line broke hard and prices flushed.
Yep, that's definitely true. And so in this case, after we had this drop, I might have drawn another trend line from the low of this dot to the low of this one, which would have brought the line just a smidge bit lower. It probably would have been crossing right in here, but then you would have seen, okay, we've got these two support lines. So if they both break, as they finally did here, we could get a really big drop, and we're not going to see any support now unless we draw some type of descending support line coming down here. But a lot of times I try to be careful about crossing too many lines, because then again, you're getting a little obscure, and you want to be connecting dots that are obvious and that other people will connect, because the only reason that the stock bounces here is because other people connected the same line and they saw potential for support. So if you're connecting obscure dots and no one else is doing it, you'll be the only one buying there. The stock's going to keep dropping. Right. So anyways.
Yeah, it's very easy to come up with these trend lines that you might think are trend lines, but ultimately the goal is to find the trend line that everybody else is watching, so that you get the reaction that you're looking for. through the help of other traders.
So usually I say the validity comes from a trend line tapping multiple times. So like this is a long one with just 2 taps, but then in here it starts to gain some validity as it's really showing that this is a recognized level of support. So most people would consider this bearish, the way the stock is consolidating at the trend line before, of course, breaking down.
Yeah, to add on to what you mentioned, sometimes it is okay to use those 2 points, but I like to only do it in situations where I'm using the most extended points, because ultimately I know that not all trend lines are going to be respected, but I still want to have them plotted just in case that they do provide some kind of support, and that could help me kind of understand what's really going on. So in this case, we had those 2 extreme lows plotted there, and we created a trend line from that. But even though we didn't know whether it was going to come into, it was going to provide support, since it was only 2 points, it's still helpful to kind of mark those places off, because you never know that may be a level that other traders are using. For
that's
support.
true. And remember, you have to not forget that the reason technical analysis works is because thousands, millions of people are all using the same tool, right? So I think that's why those 4 big tools of trend lines, support and resistance lines, volume, and moving averages work so well. They're the most common technical indicators that even when you first load, an E-Trade account or whatever it is, they're automatically on the chart because they're what everyone uses. So the fact that a setup is really obvious is good, because more people will recognize it, more people will most likely buy at the logical buy entry spot, and you're going to see better resolution. So, we really like to go for what's obvious rather than trying to, come up with some very obscure combination of never before heard of technical indicators, because no one uses them, which means those levels won't be very respected, and you'll most likely just get yourself frustrated. All right, so support and resistance levels. Do you want to cover this one, Arsh?
Yeah, let's get into it. So we have here support and resistance levels, which are literally just horizontal lines that we can plot on a chart based on what we identify to be major trading levels. So some examples of major trading levels you might find on a chart include previous major breakout and breakdown points, extreme highs and extreme lows, as well as price levels that have been previously tested and held on more than 2 occasions. So it's important to note that support levels can become resistance, and resistance can actually become support.
Right. Yeah. So let's look at a couple examples here of support and resistance lines. So what we look for, again, are places where the stock has ideally tapped multiple times. So right up here at the high, we've got this candle squeezed up here, and this is a topping tail. So oftentimes I'll draw a support or a resistance line at the high of a move or high of day. And so if I draw that on there, it creates this line right here. And it's very common that when a stock squeezes up, if it creates this is called a cup formation. It creates this cup formation that what it's going to do is it's going to double top at the resistance line, and it's going to fail. So we anticipate that. Now, that means we often like to buy at the bottom of the cup, which is what we would call the bull flag entry. So we're buying down here, and we want to sell at the top of the cup. There are times where stocks or cryptocurrencies are really strong, and they squeeze through that and they keep going. But oftentimes they see a little bit of resistance. And this is the moment where stocks will either pull back and completely fail, the way this one did, or where they'll form a handle, which is that little bit of kind of pullback underneath the top of the cup. So it's that little handle right here. And then from that point, they usually continue higher. So drawing the resistance line at high of day, this gives us a predictable level of resistance right here. Similarly, the stock drops down, the low of the drop, we pop on a support line. Now we see here on multiple occasions, the stock kind of drop below, bounce back up, drop below, bounce back up. So we're sort of seeing some support in this area. And again, one of the things that can be a little challenging, especially with cryptocurrencies, is that because there's so much fear and greed around these trades, these currencies, you can see whips where they break below support and then they do come back up through it because people panic out. Or people, greed and they just panic in. They buy in because they're afraid of missing out. They've got FOMO. And so we see a little bit more of the irrational stuff. Like in this case, you sort of see 1, 2, 3 taps in this $10,000 level. Probably a little bit of psychological support there as well because it's a big round number. The low of this drop here, we could draw that over. This is a good example also where once this support level was broken, as we came back up, it was also resistance. So now it's forming the other side where first it was holding us up and now it's a wall keeping us from going higher. You can see a little bit of trend line support and resistance here, or the support and resistance horizontal lines on this 4-hour chart. This drop here, you can see we've got a tap there and a tap there. So that's a really good example of those two levels, coming up and running into it. Is there anything else you wanted to cover on this slide?
Yeah, so we could also cover that the major breakout points also kind of tend to provide some considerable support. So on the Bitcoin daily chart, you can see that we have the major breakout point listed, and we really just identified as that as the low of the green candle that really started a huge up move. Right. That's where that big move really started, and before it kind of just gained incredible momentum. So now that we're finally back down to that level, you can kind of expect it to be an area where some buyers are going to come in. So if you look on the 4-hour chart, we first pivoted into it, bounced a little bit, dropped through it, but now we're recovering back up and kind of consolidating over that level. So that kind of tells me that buyers are using that as a level of support, right, to place their trades on Bitcoin.
That's a good point. Yeah. So this trend line here is carried over from the daily. So sometimes actually we do this a lot. We'll draw trend lines on the daily chart. And then when we're trading intraday using a 4-hour, hourly, 15-minute, or 5-minute chart, we can see, okay, this is that level that we marked out over on the daily chart. We're coming up to it. And so this is where you can kind of see us coming up to that level right in here. And that's the same with this trend line coming up here. But you can also draw these support and resistance lines intraday on the 4-hour chart as you see them. And again, they're as respected as basically if they're really well respected, it's because they're really obvious. So the more obvious they are, the more likely they are to be respected by other traders.
That's a great point.
Here's a chart on Litecoin. You want to talk about this one a little bit?
Yeah, so we kind of see similar support levels here on Litecoin. We have the extreme lows from the previous major sell-offs, right, where we saw that first Litecoin had broken out incredibly sharply, and then when we had that big sell-off day, right, we bounced pretty sharply off of that level. Yeah. So you can kind of plot that level to be and expect it to be a support level if it's ever tested in the future. And that's what we saw following a couple of weeks later, where we once again spiked into that level and we used it as support, bounced higher, but eventually we curled back down and we plotted another support level at the new extreme low.
Yep.
So but what we're seeing now is that Litecoin's kind of using those levels as support, even though it's not the most perfect support bounce there is. Those are the best levels that you can really use to determine support. There's not really much else you can identify on that chart to be a major support level. So
yeah, and this is what technical really trading is all about. It's looking at what are obvious possible levels of support, and we look at the lows of extreme drops and things like that. So those are carrying over into this 4-hour chart here. So you can see, especially in this area, a little bit of consolidation bouncing between these levels. And something that, again, is also worth noting is that we definitely see resistance at whole dollars, half dollars, and just big kind of lines in the sand that are psychological. So 150, 200. Or even 210, 220, 230, 240. It's not uncommon to see kind of a little bit of a tap against these whole round numbers and a fade off that level. So when I get in to these trades, a lot of times I look for them to break and hold over those levels. And when I look for my target, I like to sell just underneath those psychological areas of resistance. I wouldn't want to sell exactly at 250. I would sell at like 249.80. because I would expect we might come up and tap, and then we could get a sharp rejection off that psychological resistance. So in addition to obvious support and resistance levels, we also have some of the psychological ones, which initially may not be as obvious, but are definitely a factor.
So here's actually a similar analysis on Ethereum. This one really helps us kind of understand the importance of previous major breakout points. So if you look on the 4-hour chart, that major breakout point that we have identified there, it provided support not once, but twice.
Right. Yeah, I see
On
that.
the first bounce, we jumped literally from that level, and it bounced for over 30% from literally that breakout point, which means that other traders had identified it and possibly placed their orders at that price point ahead of time. So when price came into there, their orders would be filled, and it turned out to be a remarkable trade for anybody that bought the dip there, because it just led to an incredible bounce. We also see that there's a good example of support turning into resistance on the 4-hour chart. We had the extreme low level plotted, which when Ethereum finally snapped back into it, it found support or resistance where we have the green box marked. So these kind of levels really kind of help you understand places where you might be able to buy and sell for a trade.
Yeah, these are all really good examples. And again, once you kind of learn this language of where to draw these trend lines, you can apply them to any type of stock. You can apply them to Facebook, Amazon, Netflix, the high price stocks. You can apply them to the low price stocks. They are really well respected across the board. And in fact, they're so well respected that there's algorithmic support at some of these levels where there's computer systems that actually take into account this is a place where the computer is going to be a big buyer. And so when we see support, the stock is dropping down, and we're like, geez, it's not dropping anymore. There's big buy orders. Where are they coming from? They're a combination of algorithmic traders. They're also traders with deep pockets that are very experienced that put out orders days or weeks ago thinking, if we retest this spot, this is where I would be a buyer. Even if I'm out to lunch, I want to get picked up right here for a bounce. And you saw it just like to the penny right here on this dropping out of the against the support of the prior breakout. All right, so volume. Volume is something that I actively use on every single trade I take. Now, when we were giving you the walkthrough, showing you GDAX and Coinbase and everything, you were able to see the ladder, which is the level 2 is what we would call it, the depth of the market. And then you were able to see the time in sales. And the time in sales is a transaction list. It's a list of every single trade that goes through, and it's just constantly running 24/7 in the case of cryptocurrencies. So volume is, and the volume bars are just that visual representation of the amount of transactions that went through during each candlestick period. Now these are colored red or green, not based on buyers or sellers, but based on the color of the actual candlestick. So that's kind of a little bit deceptive, because there could be times where you have a green candlestick, but a lot of the volume came from one big seller who just happened to sell like 50,000 shares or 50,000 coins or whatever it is. But for the most part, we sort of just acknowledge that we color the candlestick and the volume the same color. So the candlestick up here, and then the volume would be down here. So that's the reason, or that's how we decide the color of them. Now again, one of the nice things with volume in this sort of view is that you can visualize when we have high volume and when we have low volume. And one of the things that we really like as active traders is to see a lot of volume in the stocks or the cryptocurrencies that we're trading. So a place that we would be interested is right here. And without even seeing the chart, we know that the candles were going down right here, and they were starting to go down with increasing volume, which probably means the stock was dropping pretty fast. And then this must have there might have been a little false bounce right here, and then a more sustained bounce right here as we started to come back up. And then, so what I would visualize this chart looking like is the stock dropped down, it bounced up, and then it kind of went sideways for a while. This is probably sideways. It could be slightly down or slightly up, but it's most likely not anything too extreme. When we see extremes in volume, those come with extremes in price for the most part. And high volume is what we like. We like to see lots of trading taking place because that means if we want to buy and sell in large quantities, there are buyers on the other side that we can sell to, and there's sellers on the other side that we can buy from. And so it's going to be very liquid, very easy to get in and easy to get out. So when it comes to technical analysis, volume is what we would kind of consider to be a confirmation. So we may see what we think is a nice strong pattern, or we may see what we think is a strong support level, and it's the volume that will confirm it. The volume is what tells us other traders are buying at the same place that I'm buying. That means I must be right that this is a breakout spot. I'm not the only one who saw it. So volume is incredibly important for confirming that these patterns that we thought we saw are in fact legitimate. So here we can see volume on this chart, and as you would expect, some of the big breakout days are going to have higher volume. Some of the big selling days are also going to have higher volume. What is kind of interesting with Bitcoin and with some of the other cryptocurrencies is that some of the big moves actually occurred on fairly light volume. For whatever reason, there was just an imbalance where there weren't a lot of traders, but the traders that were there were all buyers. And the prices just went up very, very quickly, which is a little different from what we typically would see trading stocks, although it does happen from time to time that you will have light volume breakouts. They're typically just the result of, someone sees the breakout like right here. And so the only people buying here are, obviously people that saw this consolidation, but it just so happens that it wasn't as many people as were trading it back here. So ideally, we like to see high volume at the breakout, but ultimately the price is what's most important. So we want to see the price moving up and moving up sharply. But you can see here, this is that consolidation.
What you can definitely kind of pick up from that, though, is when we did see that huge volume spike, and it nearly took the prices to all-time highs. That can kind of give you
early indicator.
Insight into an early indicator in what may potentially happen in the future. So if we saw that much volume come in and the prices nearly went to all-time highs, you can only imagine what prices may do in the future, right? And
that's true.
That's exactly what happened here. Is what we saw, the big volume spike. It took a few days of consolidation, and we moved out of that bull flag on not tremendous volume, but it was enough to really carry prices pretty far. So it's really important to keep an eye on volume to get an understanding of what price may do in the future.
Yeah, those are good points. And likewise, when we see drops or we see periods of consolidation, we like to see that they're on lighter volume in a lot of ways, because that indicates more of more churn rather than panic selling. So, a little bit of a drop, but it pops back up and it's on light volume. That's not as concerning as when we see a drop on really heavy volume. Like back here, this is something that would be a little bit more concerning. But, this is, even though it's the highest red volume of the day, we have bigger red candles right here and up here, a few months later. This just happened to, at the time, be a day where some traders panicked out a little bit because it was a relatively big drop for that time. So let's see. Here's another Bitcoin chart. You want to walk us through this one?
Yeah, so it's another great example of how you can kind of use volume to your advantage to kind of get an understanding of what may happen. So we saw that prices had really started selling off from the high of about 5,000. We dropped all the way down to 3,000, which is a pretty steep drop. But what you saw is that huge volume came into the buy side right there. So that really kind of tells you that maybe a single party or many parties are really getting involved at that point, and they're taking ownership of Bitcoin at those prices, and they're really voting that these prices may go higher, and that's why they bought so much. Sure. So over the next few days, we saw just a little bit of consolidation, and then you come out of the bull flag, and boom, the prices just took off from there. And really, that big volume spike of that day is just critical in kind of seeing that happen before it does, because it just gives you just great insight into the price action of the market.
That's a good point. Despite the selling, more buyers came in to step up to the plate to buy it up on that dip, and that is a real sign of strength. This isn't quite a bullish engulfing candle, but a bullish engulfing candle is when you have a red candle and then the following day the green candle is fully bigger than it. It opens lower, it closes higher, and it's just basically, it totally shuts down that red day. And this definitely did it with the volume. It almost did it with the price, and it certainly did over the next couple of days.
We could see it here again on Ripple as well. When we started breaking out to all-time highs, the volume just really kicked up to another level. And seeing that can just help you predict that these prices are probably going higher. And that's what Ripple did when those huge buyers stepped in. We got all of that volume, and these were fresh all-time highs. So it could have really helped you kind of predict a breakout in the making.
Now, what's interesting with this is that we had peak volume here, over 600 million coins traded on these high volume days. However, remember, at this time, it was around 50 cents per coin. So here, when it's up at $3, if we were actually looking at this not just in dollar and not just in number of coins, but in the volume of currency that changed hands, you'd see that this was actually increasing because the price went up. And yeah, the volume came down a little bit, in part because buying 10,000 coins is much more expensive on this day at $2.50 than it was back here at 50 cents. But the transaction value is going up. So that's something that you may not see at first glance, but you should be aware of, especially when you're looking at something that went from 30 cents to $4 or $5.
That could be a pretty bearish sign as well, right? When you see that declining volume, kind of shows you that not as many buyers are stepping up to the plate. Yeah, even though the prices are higher, in this type of move, you really want to see the volume continue to increase.
You prefer to
kind of, right.
Yeah.
That'll kind of show you that prices may continue to go higher in the future.
Yeah.
But in this case, the volume just slowly ramped down. So that should have kind of given you a hint that maybe this movement was coming to an end.
Yeah, I think definitely when we see decreasing volume, it is an indicator that, okay, the move is getting overdone. But if you also were plotting the transactional volume, the actual amount of dollars that are changing hands, you would see that it's probably actually flat or going up slightly because the price went up so much. So that's a little on the bullish side. So it does make it a little bit mixed as to, okay, it's breaking out on decreasing volume, but the price more expensive. So yeah, it's a little bit of an iffy one. I would say in any case, I'd be definitely hesitant, buying it anywhere up on this high level because obviously it just came from, 20, 30 cents.
Here's the same example again with the volume, just to kind of show you guys how important recognizing that volume could really be, because here we saw that Ethereum really kicked up its volume on that first breakout to just unseen levels. We had seen that level of volume in the past, but compared to the past few weeks, it hadn't seen any volume like that. So when you finally got that huge kick up in volume, as well as prices having just reached new all-time highs, that could have provided you an indication that prices were ready to continue much further, which they did.
Right, and this is an example here where we have our support or our resistance level, which was all-time highs. We came up, and as you can see here, this is the 15-minute chart, so it's a zoom in of this day. We squeeze up, we break through all-time highs, but then we reject them. So it goes all the way up to 880, drops back down to 800. So, fairly big false break, and then it curls back up, but it kind of struggles and churns around this daily kind of support resistance level until finally this becomes support, and that becomes the low of the next leg up, which starts right here, right? So this was previous resistance, which becomes support. So again, using all of your technical indicators to help you get that edge, so you're making the best decisions about where to get in, where to set your stops, etc. So moving averages, this is another one of the indicators that I use a lot. So what a moving average does is it tells you the average price over a fixed period of time. And you can choose what period of time you look at. So the commonly used moving average lengths would be the 20 moving average, the 100, and the 200. So a 20 moving average is the average price over the last 20 candles. And so again, this can be a little bit deceptive because the 20 moving average on a daily chart, well, the average price over the last 20 days is different from the average price over the last 20 minutes if you're using a 1 minute candle. So the 20 moving average is not the same on all charts. It's really relative to whichever time frame you're looking at. So we use the 20, the 100, the 200. For me, as an active day trader, I also use the 9 because it's an even shorter period. So it's telling me the average price of just the last 9 candles. So those are moving averages. Now, within moving averages, we have 2 different types. We have the simple moving average, which does exactly what I just said. It's the average price over the last X number of candles. And then you have the exponential moving average. And what this does is it weights the more recent price action heavily versus the older price action. And so that means when the simple moving average is going like this as the stock goes up, the exponential is going like this. It's moving faster. And we like that. I like that, at least for day trading stocks, because it reacts faster. It's, to me, going to be more accurate. So for me, I use the 9, the 20, and the 200 exponential moving averages. And what do you use for on your charts with crypto? Are you using simple or are you using exponential?
I'm using simple.
Yeah.
And I think I use the 20 EMA, but the rest I use simple moving averages.
So again, it really comes down to personal preference, but at the same time, I'm using the indicators that I think are the most widely used among day traders of stocks. So day traders of stocks, I think, are using the 9, the 20, and the 200 exponential. The 9, the 20, and the 200 simple are also going to be very similar in price. It's not that different. So again, me using the exponential might give me a little bit of an edge over someone else who's using the simple. And it's probably the same with cryptos. A lot of traders, when they load up their charts, automatically will have simple moving averages installed. So it's what they come with, it's what they initially learn, and so they will be inherently more respected because more traders are using them.
Right, right. One thing to note is you definitely want to stick to one or the
Sure,
other because there is similarities between the two, but they can still provide contradictory trading information. So you want to use the one that you find works best for you,
Right.
which in most cases it's the exponential, but some people also like to use the simple as well.
So what you see here, these are the moving averages plotted on this chart. And so you see right here, this is a level of support. The stock is actually finding support at the moving average. Right here, the stock is finding support at the moving average. This is very common. So now we see a couple of charts and we're starting to add the layers of indicators. We've got the candlesticks, we've got the volume, now we have our moving averages. And of course we could draw on our trend lines as well. And so you can see as the stock squeezes up, it really holds this green moving average. So what we would typically say is that we like to buy at support. This moving average is a pretty good level of support. And so entries at the moving average with exits as the stock squeezes away, getting back in at the moving average, exiting as it squeezes away, back in at the moving average, exiting as it squeezes away, maybe back in here, exiting again, back in down here, maybe you stop out, maybe you don't get in until it breaks back above because this was 3 sharp days of drop. But again, you sort of get the idea of we're seeing the stock or the currency, in this case Bitcoin, respecting these moving averages. Did you want to add anything on this slide?
Yeah, so I really like to incorporate moving averages to kind of get an understanding for the overall trend.
Yeah.
So most frequently I like to use the 20 EMA since it's so short term and it's going to react to more immediate price term. But the 100 and the 200 can really help to find major support and resistance levels that previously haven't been tested. Like in this case, the 50 EMA or the 100 SMA had only been tested on one occasion back in I think it was September or October, but it didn't get retested since. But once we finally did come back into it, we saw that the 100 provided a decent level of support. And then similarly, you can see the same thing happened with the 200. Although they weren't like sharp bounces precisely off of those levels,
Yep.
I'm pretty certain that the reason we're seeing these bounces at these areas is because people are seeing that we're coming into these major moving averages, as well as other technical indicators that we've outlined earlier, like the major breakout point, the round numbers.
For sure. And one of the things that we talk about this more in the day trade course. And we also talk about it in a couple of our terminology video lessons. There are some traders put a lot of respect on moving average crossovers. There's the golden cross. There's also something called the alligator indicator. So what they're basically emphasizing is these moments when moving averages make really strong crosses like this, that these are very significant. And so in this case, obviously, this is a very bearish signal. And the crossover, when it first happened, was way off. It's not even on the chart. So traders like that would sort of have the attitude of, I'm holding this, I buy on a crossover, and I'm not going to sell until a crossover. The problem with that, obviously, is that it's not very precise. And by the time you're selling down here, you're selling at like 50% off of all-time highs. So you're really not getting the best exit. I mean, yeah, you held for a long time, but we talk about that a little bit. It's not as helpful for trading on the daily chart. It's a little more helpful for intraday. Some of the indicators are also commonly used on Forex. But again, mostly on intraday charts versus the daily. So now we're going to talk a little bit about common price patterns. So these are some of the things that I love to talk about because I use these every single day when I'm looking for trades. So the most common price patterns that we're going to talk about are patterns of consolidation. It's fairly self-explanatory. Patterns including bull flags and patterns including bear flags. So flag patterns are essentially periods of consolidation, but in a certain context. So we'll explain that context and what that looks like. Now, we use these price patterns really to help us understand low risk entry points where we can minimize our downside risk and maximize our upside potential. So this right here is a bull flag, and the stock is consolidating sideways, but it's consolidating against a descending resistance line. So that trend line is coming down. And it's going to come to an apex point, which is where the horizontal line and the trend line meet. And stocks generally will break out either to the upside or the downside, either at that point or before that point. And in this case, it did it before that point, and it broke to the upside. Now, we don't always know when stocks will break these levels, whether it would break here or here or here. And we showed this example in one of the earlier classes, but it broke here. And my typical entry is to buy the first pullback, which is right here. As a day trader, I often call it the 1 minute micro pullback. Sometimes it's a 5 minute micro pullback, but it's a short little pullback after a fresh breakout. A bear flag is a flag that is occurring after a drop. So a stock that drops and pops up and then consolidates a little bit, usually before another drop back down. So this is a bear flag here. This is a bear flag right here. So here, let's look at a little zoom in of consolidation. So this is a chart where we see this sideways consolidation. So this is churning. You have some people buying, you have some people selling. It can be kind of a sort of accumulation, distribution, just churn. It's sideways. And sideways can last for long periods of time, and it can break out to the upside or the downside. So we don't really like to buy when stocks are sideways or currencies are sideways because we don't know how long they'll continue to be sideways. So instead, we like to just sort of chart out the consolidation, map out the resistance lines on the top, the support lines on the bottom, figure out where that apex point is, which would be right here, and then make a decision of, okay, well, we're in consolidation. So if the stock or currency breaks over this level, I want to buy. If it breaks below this level, I'm either going to short it, or if I'm still holding it for some reason, maybe I would be selling it. So consolidation can turn into a bull flag or a bear flag, but there are times where the consolidation is so long that it really isn't even a flag pattern at all. It's just going sideways. It's not very interesting. It's
Right.
maybe drifting down a little or it's drifting up a little, but it's nothing that we would buy. We would wait for a breakout or a breakdown to occur. And we would want to, of course, see the associated volume that comes with that. That tells us that other traders are seeing what we think we're seeing, right? They're seeing something
Right,
worth
right.
buying.
Right. Yeah, these consolidations are really important to understand because, in simplest terms, what a consolidation really is, it means that the buyers and sellers are kind of evenly matched
Right.
and there's not much volatility going on in the price. But when the consolidation finally begins to, or when the price finally moves out of that consolidation zone, it kind of means that the momentum is starting to build and potentially uncoil in that direction.
Yeah.
And it's really that's when the pattern can turn into a bull flag or a bear flag, which could kind of help you uh, locate these great trading opportunities. And we'll talk more about the specifics of the bull flag and bear flag in the following slides.
All right, so here we have the bull flag. This is one of my go-to patterns for trading small cap stocks. It works really, really well with small caps. It doesn't work as well with large caps, with your Facebook, Amazon, Netflix, Google type of stocks, but it works very well with small caps. It works very well with cryptocurrencies. So what is a bull flag? Well, a bull flag is when a stock pops up and creates a spike. That's the flag pole. Then the flag is sideways consolidation after the spike. So that's just this kind of period of digestion, just sort of churn. And what we typically expect from a bull flag is that this period of consolidation is where some people are taking profit from the first move, other people are beginning to accumulate positions, short sellers are maybe starting to cover, and then we coil and we break out. So it's this period of tight coiling and then the breakout, which occurs as we break over this trend line right here. So a bull flag can be as small as 3 candles. This right here is a bull flag. We've got 3 candles going up, 2 candles going down, and this is the first candle to make a new high. It's a small flag, but it is a bull flag. And this right here, this whole thing is also a bull flag. We've got 3, 4 candles up and then, a long period of sideways consolidation, but it's still a bull flag. So it can occur on all different time frames from the 1 minute to the 15, 60, 4-hour daily chart. And they can take anywhere from 1 candlestick or 2 candlesticks to form to 15, 20, or 30. It really is,
Right.
It doesn't matter.
One thing to note that when you're buying this kind of bull flag pattern, you really want to see a spike in volume where you're seeing the breakout, because that's telling you that other traders are also getting involved at that same
Right.
point. And that's a very bullish sign to see increasing volume as that breakout is happening, because as mentioned, it really just means that other traders are piling into that same trade, and it's a pretty good chance that prices are going to continue higher.
So that's the important thing to remember in general about the market, is that the market is an island where millions of traders are coming together. And so the prices and everything that we're seeing, it's a reflection of market sentiment. And that sentiment is created by traders who think this is a place I want to buy. And so they start buying and the price starts going up and more traders start buying and it keeps going up. It's just so interesting how the market really is just a collection of it's a reflection of the emotions that traders experience: the fear, the greed, the excitement, the exuberance. It's all on the charts. And so we look for opportunities where we think that the excitement is going to build and peak and create these breakouts. And so in this case, it was right here and then again right here on the second pullback. So we'll zoom in here. You can walk us through this Ethereum chart.
Yeah, so what's cool is that these patterns can really take place on any time frame. You can
Right.
find them on the 5-minute chart, the 1-hour chart, and in this case, we saw it on the daily chart. So we initially saw that Ethereum went from a low of about $8 all the way up to 400. So that kind of created the pull of the
Yep.
flag. But over the course of 4 or 5 months, or actually it took a while, we consolidated for quite some time. And what's interesting is that the consolidation kind of really began to tighten up as we came into, I see October right there. So once that started happening, that really told you that buyers are holding up the price on every little dip, and you're not really seeing much volatility take place. and it kind of shows you this coiling pattern that's happening. So in this case, we have the flag marked off with the 2 points, the 2 extended points we noted, and then once we finally started curling out of that line, the breakout really just gained so much momentum, because what's really happening here is buyers are seeing that prices are not going lower.
Right.
And that's where everybody starts to pile
Right.
in, and that just turns into a major breakout point, and can really lead to some interesting trades. So in the next slide, we could see how that pattern really unfolded over the following few months.
Sure, I'll show that one. Let me just show you guys one thing here. In the context of this one chart, you can see how you have, it's almost like fractals, because you have within, this is a flagpole right here for this long flag that occurred right through here. So this is all one flag. But then just inside the flagpole, we've got this bull flag right here, right? That's a flag. And we've got another one right here that's pretty well defined. That's a flag. And we've got another one right here. So all of these are little opportunities that eventually ended up, forming this one large flagpole that created this, large pattern out here. But you can zoom in and see these on smaller time frames, and whether it's intraday or it's daily and short little weekly periods like this, or you can step back and see them on this very high level where you see this long period of consolidation. And in that case, buying down here is buying the dips of the moving average and then selling through the breakout, especially as we get over this descending resistance line. All right, so you want to walk us through this Ethereum daily chart. So this is, well, basically, and I'll let you walk us through it, but this is the continuation. So this was the chart we were just looking at, where we saw right here was the breakout point, and now we're looking at it a few months later, and this was what that breakout produced, right?
Right. So you really see the result of what that breakout did for prices. It kind of, once the uncoiling finally happened, the buyers really just let loose on the price, and we went from 380 all the way to about 1500. So it really shows you the power of those kind of patterns, and what it can help you, how it can help you to predict these huge potential future moves, especially in cryptocurrencies where we see so much momentum. Once the momentum really gets going, prices just seem to let loose.
Yeah. I mean, this is where we saw that really big move. And again, this is kind of interesting because it's actually on lighter volume than we saw, on this candle back here. But this might be sort of that early indicator of the stock, the currency dropped, and lots of buyers stepped up to the plate. They bought it up, and then here we get the breakout a few months later. So it's kind of interesting to see that similar indicator. All right, so here we have a Bitcoin chart. We've got our moving averages on here, and you can see a nice flag right here, this consolidation. This is a resistance line we draw. This was the breakout, the volume that comes in down here. We spike up. We have another small pullback right here, another breakout, another pullback here, and another breakout. Small pullbacks here and small pullbacks here. So you can make a living trading just this pattern, because it is one of the strongest patterns, and it's a universal pattern. You know it for stocks, you know it for cryptos, because it occurs in the same exact way. Is there anything else you want to add on this? I see that nice bounce on the 200 right down here.
Yeah, that was great as well. Really incorporating all of these different technical tools and indicators can really just help you develop such a great edge over the market. Right. Just the bull flag pattern itself is a great way to go about trading these cryptocurrencies, since what they really just help you understand is they help you predict these major breakout points, because once you get out of that consolidation, everybody starts jumping on the train, and that's when prices start going. Right. So you really want to learn to be able to identify these breakout points using these flag patterns, and you want to sell into the breakouts. And that's really going to help you potentially create substantial trading profits.
Yeah.
The interesting thing to note is that these patterns sometimes can be very short term. Like in this case, the Bitcoin flag, it worked for quite some time, but eventually we saw that prices finally came back down. So you really have to be disciplined about making sure that if you're taking this kind of trade, that you're also taking profits. And if you fail to have maybe taken profits up there, you really want to make sure that just don't let the trade go red at least.
Absolutely. And that's definitely true. This is technical analysis is short-term trading. It's not investing. It's not buying for the next 3 or 4 years. These are very short-term opportunities. And we use larger position sizes to profit on these short-term opportunities, and we certainly larger than we feel comfortable investing for 6 months or a year. So that compensates for it, and ultimately, most of us make more on these short-term opportunities because of the additional leverage of share size that we use or coin size, to the point where we probably make more on these than we would if we were doing long-term investments on the same instruments.
Right, right. When you're incorporating your risk management, you can really take advantage of large share size,
Right.
because at the end of the day, when you have such a tight stop, you're not going to lose too much versus what you stand to gain.
Exactly.
So here we see the same pattern unfold on the 1 hour Litecoin chart. We saw that we had a giant bounce from a few days ago. Prices began to consolidate. But once they finally broke out of that consolidation, prices started traveling higher, and that just provided a great trading opportunity for anybody that bought that flag breakout. But once again, we see that this flag pattern, even though it originally worked, it did come back.
Right.
So you really have to have that trading mindset when trading these kind of patterns, because they may work in the short term, but that doesn't mean that it's going to work. That the prices are going to continue moving in your favor. So
Right.
you have to take advantage of taking your profits when you can.
And one of the things that we'll talk about more in the class on trade execution, we'll talk about stops and things like that. But generally speaking, you always want to know, as per risk management, your max loss on a trade. And we typically would set the proper stop as the low of the flag or the low of the most recent pullback, which if you were a buyer up here, your stop would probably be down here as a tight stop. Down here would be a looser stop. And again, you determine, do I really want a tight stop or one that's got more space, based on what the profit potential is. So tight stops when the profit potential is a little more limited, and maybe a wider stop when the potential, if it works, is that you have a real home run type of trade. So here's another one where we have this consolidation. This is really interesting too, because this is occurring right underneath a trend line level of resistance. We tap it, we fall. We come back and retest it, we fall. We test it again and we fall. And this is also one of the things that we call a flat top breakout. This one's not quite a flat top, but it's not uncommon to see multiple tests of almost the same price. And the more times that gets tested, eventually we're going to break through it. Now, it doesn't mean we'll stay above it. Here's the break, and then it drops back below. Because a lot of people are anticipating the break, and so when it does happen, they take profit. Or they take profit at the earliest sign of weakness, because they're like, okay, I got as much as I could get, and now you have an imbalance where people are taking profit, they're selling. Especially in this case, people who may be in from way down here, they're taking profit, and now you get this period of sell-off.
Yeah, I really wanted to include this example to kind of help you guys understand that these flag patterns can really form even pretty far off of the lows. Like in this case, we had bounced pretty hard, and we were pretty far from the lows. And even then, we still saw the flag breakout occur. But of course, it ultimately it was sold off.
Right.
But even then, you could have still taken advantage of this as a trade, because if we had placed our stop at that previous low, right before the breakout, this trade actually still turned into a 2-1 profit loss ratio trade.
Yeah.
So, but it really helps you to understand that even though it's a good looking flag pattern, it's not just going to keep going. So you really have to be disciplined about taking your profits when you're in this kind of situation.
Yep, absolutely. So now we'll talk a little bit about bear flags. Bear flags are the opposite of bull flags. They're the exact opposite. So with a bear flag, instead of the stock popping up, the stock sells off. That creates the flagpole going down. And then after the drop, we have sideways consolidation. Typically, it's consolidation before the next leg down. So it's kind of stair-stepping down. Now, obviously, we have this problem right now with cryptocurrencies where it's not practical or possible in most cases to short them. So you really can't, there's some ways you can, but for the most part, you can't trade against the value of these underlying assets. So these aren't necessarily going to be short setups that you would trade to the short side. They're more just a pattern to be aware of especially if you're holding it to the long side, that this is a bearish pattern. You don't usually want to be holding it, and it's something that you may be able to apply in the future if it becomes more easy to borrow and short cryptocurrencies. I don't know if there's any indication that that'll happen, but it's just something to be mindful there. So this here is a stock, or the currency Bitcoin dropped down and then it bounced up. This right here is sort of that telltale sign of a bear flag. It's an ascending support line, but after, it's in the context of this recent drop. So it's kind of moving up, and then this is the apex point where we drop back down, right? So not the prettiest pattern for traders who want to see these going up. Is there anything you wanted to add on this one?
Right. Yeah, just to add on to what you were saying, it's just really great to be aware of this pattern, since you really can't short the cryptocurrency, but in case you're long, you want to be aware that this type of pattern really means that prices could go lower. Yeah. So it may help you exit a position before taking further losses.
Right. Yeah, that at this point would be sort of the best value. And here's another big drop. This ends up actually being a pretty nice bounce back up, but it kind of is just a long period of sideways consolidation below the original breakdown point. So this is the breakdown point here, the drop, consolidation, and then a further drop here. And again, it doesn't mean these are going to zero. It's just a short-term correction and pullback before possibly turning around, as you see here, and making its way back up.
Right. So say if you're long-term invested or something in Litecoin and you saw that pattern, what you could really do to take advantage of it is maybe you would have sold out your position there and then had the opportunity to buy it back for much lower prices.
Right. Yeah. So all right, so what we've done is we've walked you through the 4 important technical indicators that you really need to understand to start to become proficient at technical analysis. We talked about trend lines, ascending and descending. We talked about support lines, the horizontal lines, support and resistance. We talked about our moving averages, exponential and simple, and we talked about volume. And then, of course, we talked about the actual candlestick patterns of bull flags, bear flags, and the consolidation pattern. So these are going to equip you to start becoming a more confident trader. But remember, you have to practice all of this stuff. I remember for me as a beginner trader, not even just as a beginner, I'd been trading probably for over a year. When I had a day, I remember sitting down and looking at a chart and feeling like I don't see anything. I'm looking at an entire chart. I don't see a single pattern. I don't see anything to buy or sell. It takes a while to sort of adjust your eye to visualize these patterns. It's like looking at a magic eye poster. You don't see anything, and then it's all right there. And so we're trying to help you get to the point where you can start to kind of visualize through everything, the patterns, and being in the chat room, we're going to show you these. We're going to point them out every time we see them, and it's going to become second nature, but know that it takes some time. Just like anything else, mastering this skill of technical analysis is something that takes time, and so you got to study up.
Right. And I would say that cryptocurrencies, especially, for some reason, they're extremely technical traders. Yeah. And that's likely because there's not much fundamentals driving the price. It's ultimately just the technicals that are driving the price back and forth. So if you're really interested in trading cryptocurrencies, you should make sure that you're really focusing on your technical analysis skills, because that's what's really going to help you develop your trading edge. If you can recognize these patterns for what they are and take the trade before the pattern takes place, you could be involved in some great trades. Yeah. But at the end of the day, you still have to incorporate all of your trading rules, such as risk management, and you want to make sure that you're never, even though a pattern may look like the best pattern you've ever seen, and you still have to understand that there's the possibility that the pattern doesn't work. Sure. Because at the end of the day, it's just a pattern. So yeah. As important technical analysis is, you still have to take it with a grain of salt at times, because these are just traders' emotions that are reflecting on the chart.
Yep, that's absolutely true. All right, everyone. So I hope you guys have enjoyed this class, and we'll put together some homework for you. You guys can do the homework, and then we'll get into Chapter 5. All right, we'll see you guys soon.
See you guys.